All right, is there anyone who remember the topic that we had last weekend? Okay, all right. Guys, so everyone who tuned in today, they were not there last weekend. Because I can see more Katie, I'm sure was there. Okay, no problem. So last weekend, we were actually talking about the technical analysis. That's what we were talking about last weekend. So we did go in a chart and to try to actually do the technical analysis. Just to share a little bit, I think I still have those the analysis that we were doing last week, the one that we finishing with. I think it was JPY. Yeah, that's the one. I think that was USD JPY. So just to recap, we're trying to figure it out what other next move the market is gonna do, right? If you wanna buy or if you wanna sell, what exactly you're gonna which direction you're gonna actually take to go forward. And I remember we were talking about support here. We put a support, our resistance. We put a resistant line on top. We're putting a take profit number 2 up there if the market going bullish, and then if the market get bearish, this is where there was a stop loss under there. If you go there, you selling, then you put a stop loss so that you shouldn't have so much loss. So we can see from last week Friday, the market has been moving all the way. This is a bigger time frame. If you remember, we said we should always make sure we start with a bigger time frame so that we can analyze, we can see where we can be able to set our take profit and to set our stop loss. So that is why I'm showing on a H4 so that we can be able to see where the market has been going, right? Because it's already past this point, the point that we're preparing to see last week. It's already past. Now it's gone. It's actually above that line. Okay, so if we get to the smaller time frame, like a 30 minutes, you can see that it did break, goes all the way up to this line, and then it comes back again, break, goes all the way down as a sell, starting to pick up again. It fails to break this line. So this line has been resisting for quite some time. Here it was resisting, it resists again here, it again resisting at this place again. So it shows a little bit of a little bit of failing to actually break, goes all the way up to the higher point. So this is what we're talking about last weekend. Yes, Mr. Waters, I see the hand there. You can unmute and ask. Or is there an echo? Okay. Am I clear now? Am I better? All right. Keep letting me know if I'm still not clear, right? Okay. So let me just jump into our presentation of today. We're gonna do a little bit of presentation of today. Then after that, we're gonna come back again in a market in a chart to actually so that we can be able to see what we presented today and be able to actually see also another instrument, another pair about technical analysis, so that we can keep on polishing up over and over again until we are actually becoming, a little bit much more better. So just hold on just a second. I'm trying to log in here so that it can be live on YouTube. And I'm just getting a little bit of a challenge, but just a minute or so. Okay, thank you very much. All right. So today I actually prepared about to understand about the market gaps, and again to understand about also the slippage. The reason why I've created this topic today is because of it happened for this week before. So if you go on a chart and you look at on the Nasdaq, and you look Nasdaq maybe on a smaller time frame, like a 15 minutes time frame, you realize that there was a little bit of gap that actually was there, and actually it occurs on a market. So it actually happened 2 times, I think. So I realized that maybe it is important as well, so that we can understand what the gaps are, or what the gaps mean actually. All right. So before I jump into that, there's a few things that I want also to clarify. These are the things you should be know before starting your forex trading. So every trader, if you are a trader or you want to be a trader, you're preparing to be a trader, these are a few things that we need to have them in our mind. When we wake up in the morning, we say that today we are trading. These are the things that we need to have them in our mind, so that it can actually, assist us, regarding planning our trades and moving forward. How we're going to plan our trades, how we're going to continue with our trades, and make sure that everything is, it's actually up to par, and we are actually, trading. Okay, where is this thing go now? All right. So first of all, you will not be a millionaire in a year, which is the fact that a lot of people, when they actually, come and try to join, the trading, they think they're going to make money, immediately. They think they're going to start, becoming the millionaire at the same time. So you won't even be a millionaire in 3 years, even if you are working. And in fact, if you're starting a forex with the hope of becoming rich quick, you may want to reconsider again, and have a better plan, because this is the industry where you build your account bit by bit until it become bigger. This is the industry where you need to know how much money you are putting in and how much do you want to get out of that. So that's a lesson number 1. It's very important. We shouldn't get lied to people who say put your 5,000, you're gonna withdraw 40,000, or you're gonna withdraw 50,000, 100,000. Somewhere, somehow, we should question those type of pitch if someone is talking to you that type of a way. So we should also realize it's about the journey, not the destination. It's all about from here, how can we get to another level, right? From here, how can we get to another level, right? That's very important, so that you can have peace in your mind when you're trading. You know that this is all about growing the account. What I'm doing, it's growing the account, right? If you are withdrawing, yes, you withdraw a little bit of your money, But the most important is to make sure that the account is it's grown. You have a bigger account, and you can be able now to enjoy your trading, all your trading practically when you are doing in a market. So you keep learning. That's another important thing. You cannot actually master everything in trading at once. You need to keep teaching yourself, keep learning over, like what we are doing here. Keep tuning in. You might understand today one thing. The next week you might understand another thing. The other week you might understand a different thing. That it will make your actually your mind or your business in trading to grow, to start looking like a bigger business, and again having a bigger vision on your trading. You need money to make money. As I said, the target that you have, you need to know how much money can we put. If I put $100, I can push $100 maybe to become $500 or $700 or $1,000. But if you put $100, you want to make $20,000. That's really too much in terms of the return, in terms of how you're going to pressurize yourself. So learn about forex and what moves the market. So all major forex brokers have an educational section with a lot of resources you can use to learn about the forex and the basics of the forex. So for example, you may read of a forex trading tutorial and watch videos, and again sign up on the webinar classes or on a Zoom classes like what you did. Those are important, guys. Although I'm repeating it, you already know it, but those are very, very important to master this game. This game, it's all about continuously learning, continuously doing that thing over and over and over and over again. All right. So for the topic of today, what are the gaps, right? Is there anyone who know what a gap is in a forex market? When we talk about a gap, anyone who can give me a simple explanation in terms of the gap? Anyone? No one.
Okay, can I
Yes.
give the answer?
Yes, sir.
Recording in progress.
Yes, it's like there's a time where I was in the market, no?
Mm-hmm.
And then it got a time, I think it was on a Monday.
Yeah.
It was after a weekend where I noticed that there was something like there was like a jump between the market between from last week
Yes.
to this week. There was like a big space in between.
Yes.
And so I also thought, what happened there? Why is the market, why is it
jumps
why
like
is there
that?
space in between? Yeah.
Yes.
So that's what I think. That's what the gap is, because I don't understand what is the cause of it. But that's what I thought. That's what I noticed.
Okay.
In the market.
No, man, that's a good start. To notice that this is the gap, to identify. In fact, that's a very, very important. All right. Anyone else? Is there anyone else who have a different opinion or different idea? All right, no problem. Let's learn together. So gaps are the shape. Okay, I can see the message here. It is a reversal in a trend. All right, okay. So a gap are the shapes breaks in a price with no trading occurring in between. Like what you see, that the market jumps from one position to another without having any data, recorded on the middle, right? Without having any specific data that are being recorded or showing a candlestick that actually moves, but it jumps from one position to another, right? A gaps can happen in a moving up, it can happen gapping up, or it can happen also gapping down on a moving down, right? In the forex market, a gaps primarily occur over the weekend because it is only time the forex market are closed. So most of the time, if you are trading, if you are looking maybe without even trading, if you just say that let me just have a look on the stocks. The stocks open on half past 3, which is a New York session. Now it closes at around 10 o'clock, 11 o'clock. The whole time, there's no liquidity. There's no liquidity. There's no money moving in and out. It's just paused, right? But now, if let's say we take example a stock of Apple stock, right? They produce phones, they sell phones, they produce a lot of softwares and so on and so forth. Because of Apple, it's a United States product. So it started half past 3. It ended around 10 o'clock at night. Now, from 10 o'clock to another day, half past 3, it stopped. You and me, we're not going to be able to see the market moving. But doesn't mean the business of the Apple company, it stopped. Because we might find out people in China, while we are sleeping, they are up and running. They are actually selling those phones. They are actually designing and producing those softwares, right? People from another region in the world, they're actually, up and running. They're actually doing the business with that product. So that is why when you wake up the following day, you're not going to find it at the position that you left with. So you left it at 100 at night. Now you come back half past 3, the market open, it goes 120. You see the market starting on 120. It gapped it up, right? Because of the price has been moving the time that you are actually not seeing the market moving, the time that your market is actually closed. So those are one of the type of gaps that you find in a forex market. That's number one. So the gaps may also occur on a very short time frame, like the one that we see yesterday and beginning of this week, such as a 1 minute chart on immediately following a major news announcement, right? Take a note for the following immediately major announcement of a news announcement. So immediately when there will be a major following a news announcement, there might be some sort of like a gap in the market, depending what type of the news is actually happening. There's people that are actually trade gaps only, right? People that are actually trading the gap only. So when the market close, they close it at 100 as a price. They say that, okay, I think when it come back tomorrow and opening, it will be on 150, right? And then they open a position, leave it like that, put a take profit at 150. When they wake up in the morning, it shoot up, it just starts, it just peaks, hit the take profit, they're done. They're trading the gaps. Are we together then? Are we good? Okay, all right, let's move on. So these are type of gaps that you can see. This is gap down, leave a space. There's no any type of liquidity moving at this, and then jumps here. So those who open, let's say for example, they open the price, the position here, and they know for sure they have studied the market or they understand the market, how it works, about specific instrument that they are trading, and they said it will actually jump and get to this level. They will put the take profit at this level. Once it gap down, get to this level, it hit their take profit, it closes. Looks like it never been trading, it never been in a market, but it actually trade because they're only trading the gaps. Right? So examples of when the gapping can occur, it's actually included when the economic data is released, particularly if it is contain a data that the market isn't expecting, right? So everything, it was going good. What happened yesterday, everything was going good about NASDAQ. People, they are selling. We all know that now NASDAQ is falling because it's been falling from 16,000 all the way to 11,000. That's a huge fall. And a lot of people, they had orders of a sale. They know for sure that this thing is selling. But now there was a huge news event that were actually, happening yesterday that actually driven the economic market. And a lot of people don't know about that, right? what do we do? It will gap up. It pushes the price from where it was because of now there's so many confidence in that specific instrument to another level, to another price. So it can gap from 100 to 120 because of now the investors, they're saying that, hey guys, based on the news that are actually happening at the moment, it looks like this instrument or it looks like this NASDAQ, it will start push up. So if you look at it yesterday, there was the biggest announcement of Apple instrument increasing the salaries, doing the breaking news that it never happened before. They are actually paying over $40 their employees per hour. So which is it's a very, very huge to boost the American economy. People who are working at Apple companies, they're now going to start getting paid a little bit of more. They're now going to now start being able to afford a lot of things, feeding the money into the economy. So it makes the NASDAQ, because of Apple, it's listed on the NASDAQ, it makes the NASDAQ to push the price up. To push the price up. Now, there was another news. There was the inflation rate. There was, the G10, the global 10 biggest economic countries combining together. They were having the session in Davos. They were having how they're going to, attack all these problems that we're having with oil. Things are raising up. Those are things happened yesterday. And if you didn't know, you only realize the market gapping up from one position to another. And you wonder what exactly going on. As a major news event announcing, particularly a global and unexpected news when a trading resumes after a weekend or holidays, especially if the major news is announced in that period. So far, are we good? Any questions so far? All right. It's gonna cut in 5 minutes time. Once in 5 minutes time, let's join again so that we can actually continue and complete the session. We get in a chart, we see the gaps, we do a little bit of technical analysis, then we're done for today. But once it cuts, just click the button, rejoin again. Okay, so why are the gaps important, or why are they important? Why do other people consider to actually trade these gaps, right? A gap can actually give an idea of the market sentiment. When a market gaps up, that means there was a zero traders willing to sell at the level of the gap. Are we there? On that point, I feel like it's very, very important point. It says the gap can give you an idea of the whole market sentiment or what's going on a chart, right? What's going on that particular. So that time when you see the gap and it gapped, if you could have been, a little bit of happy because now it gives you a little bit of idea where the market is going. The reason why it gives you the idea, it's when the market gaps up, right? It means there was a zero traders willing to push the price down, right? There were no people that are actually willing to push the price to sell or to open the position, to open the orders, thousands and thousands of orders that will push the price down. So what it does is because of there's a lot of orders that are put on a maybe, okay, let's say the price is on 100. Now on 100, there's no people that have orders to sell to continue pushing the price to 90. But there's people that are put their orders at 120, right? So the market actually jumped to go where there is liquidity. Again, when we're talking about liquidity, we're talking about money that is being pumping on in a market. When you execute a trade, you are actually telling the market that this is the money that I'm putting in a market for this trade. So those are liquidity. If thousands and millions globally, they are all actually have the position of a buy position at 150, and at 100, there's no position that is being opened. The market automatically jumped from the 100 to 150. it get. So it gives you the idea that there's a lot of traders actually right now that actually anticipating that this trade is going to buy. This trade, it will go all the way up, right? Already, so you have an idea, but oh, okay, if things are like this, let me also put my buy on it. You can enter your buy and start trading, that instrument. Any question for that point? I actually emphasize it, a couple of times. Any questions so far? All right, so far so good. Remember, ladies and gentlemen, when it cuts, let's rejoin again to finish up everything. Okay. All right. So when the market gaps down, that means there was a zero traders willing to buy. So same applies like what I explained. The market, the market, maybe Nasdaq is sitting on 100, or let's say it's sitting on 11,000, and now you find out that there's no much more people. Actually, they put their position for a buy, but there's more people that they put their position for a sell at 90 or at 80. The market will gap from 100 or from 11,000, come back to 11,500, because that's where these people put the orders in terms of buying, in terms of selling that product. Yes, Mr. Shadrach? Can you shoot straight?
Yes, sir.
Yes, sir.
Yes, sir. I wanted to ask, like what you explained, huh?
Yes.
Does let's say if the gap happens when the market is going up, is it an indication that the market will continue with an uptrend?
All right. So it get up, right?
Yeah.
Yes. That's clear indication that the market will continue buying. So let's say the market was going on a bearish trade, right? And then it's now out of the bruise from this position, get to here. So it actually means the people that are putting position of a sell, that are pushing the price, they are not much than the people that are actually, putting the price or opening the position of a buy. So it's actually indication of a buy, right? Here's another analysis that you should look at it. The gaps mostly happens on the stocks and the indices, because these are calculated in a share price, right? So if the index is combining with 100 stocks inside, one stock can drop the price, right? But if there will be people that says, yes, this stock it drops the price, but I want to buy it when it reach at this level. So it actually forces the stock to move up to that level, forces the index to move the price from 11,000 to where there's a lot of people or a lot of liquidity. I'm using people so that it can be easy to us, but it's liquidity. A lot of liquidity there is. Then from there, it starts continuing pushing until maybe also something happened. More orders, they are actually, installed about the sell, or maybe more position, or the stocks is actually, dropping the price on the stock market. Now you will see it will drop bit by bit, dropping again, right? So yeah, I don't know. Did I answer you, Mr. Shadrach? All right, cool stuff. 1 minute left, guys. Let's rejoin again when it actually cuts. So a gap sometimes results in a collective price action. In other words, after the gap occurs, the price have a tendency to reverse and fill that gap. So you see that confirmation. Ooh, my dude.